Welcome back to the Real Estate Investing Fundamentals Masterclass. We've covered a lot over these last several sessions. We've covered how the mindset needed to succeed in this business. We've covered deal flow, how to find deals, estimating repairs, how to evaluate deals, how to finance deals the right way, how to rehab deals, and just this last time, income generation, how to actually make sure that all of your deals are profitable and having multiple exit strategies and mitigating risk. And today we're going to wrap it up with wealth building. So if you've been paying close attention throughout this masterclass, you already have the proven systems and fundamentals to succeed in this business. Like real estate, it's not a difficult business, but it does require work. I think I've been pretty clear about that. Like this is business, and business requires work if you want to be successful, but you have the proven systems and fundamentals to be successful. And all you have to do now is just put in the work. And I'm going to show you what can happen if you put this hard work in and you allow that hard work to compound over time, ultimately giving you the financial independence and the financial freedom that I'm sure you all desire. But first, what exactly is financial freedom? What is financial independence? These are buzzwords that you hear a lot from financial gurus or real estate gurus out there promising that one day you're going to be super successful and you're going to be sitting on a tropical beach, sipping on pina coladas or driving around in Lambos or whatever. However you decide to spend your wealth is irrelevant, but I do want to make sure that we understand and we're kind of on the same page of what these terms mean. Financial independence is having enough passive income to cover your current expenses. So if you have enough passive income that's coming in that covers all of your basic expenses, all of your current expenses based on your current lifestyle right now, you're essentially financially independent. In other words, you're out of the rat race. Like if you were to lose your job or maybe step back and take a leave of absence, like a non-paid leave of absence or something for some period of time, you wouldn't be worried about paying your bills because you have enough passive income coming in every month to actually pay your bills. And this is a really good situation to be in. And depending on your lifestyle, it's something that you can achieve in a very short amount of time. If you ever played the game Cash Flow, Robert Kiyosaki's game Cash Flow, there's one of the professions that you can be is the janitor, and the janitor actually makes the least amount of money, but they also have the least expenses. Therefore, it's actually somewhat easier to get out of the rat race as a janitor versus if you have really high expenses, it's difficult. So this is something that anyone can achieve, and you definitely need to strive to achieve financial independence because it not only is it going to reduce stress, but also make sure that you're not, you don't feel trapped in a job or regardless of whatever happens with your job in the future. Now, a level up from financial independence is financial freedom. And this is when you have enough passive income coming in, not just to cover all of your basic expenses. Like it goes way beyond that. It significantly exceeds your basic expenses to cover your dream lifestyle. So you're no longer concerned with costs of certain luxury items. And I'm not talking about to the excess. And of course, it would include excesses like, private jets and things like that. But it doesn't necessarily have to mean that. But essentially, you just have enough passive income coming in that vastly exceeds your basic expenses to where you're not just independent, but you're truly free. Like there's really not, any worry at all about your financial situation when you're financially free. And in other words, financial independence is comfort. So you're very comfortable because you have enough money coming in, covers your expenses, even though you may have a job, you may not, but you at least have enough money coming in passively to cover your expenses. And then financial freedom, this is lifestyle. And anyone can achieve financial independence. Like it's not difficult to do that. And even within a few short years, depending on your situation. My wish for you, though, is to strive for financial freedom to where you can live that dream lifestyle. And that dream lifestyle is different for everyone. Like I'm not talking about sitting on a beach doing nothing, just drinking pina coladas. Like it's okay if you want to do that, but whatever freedom means to you, charity, or maybe it's taking another job that may pay significantly less, but you just enjoy that more, setting up foundations, whatever that means for you. I really hope that you really strive for financial freedom, because it really opens things up, and reduces a lot of stress too when you know you have so much passive income coming in that it not just covers your expenses but everything else that you may have, and really helps you do and be more and have more impact, not just in your life but everyone around you. So one thing to really uh, understand here, though, is this isn't based on an income. Like financial independence, achieving financial independence or financial freedom is not necessarily a certain income level. It really boils down to how much passive income you have relative to your expenses. So if you have $30,000 a month for passive income, like for most people out there, like they're probably passive, you're financially free at that point based on your current situation, your current expenses. Most people probably going to be financially free if you have $30,000 a month of passive income. But if you have $30,000 a month in expenses, then you're not financially free. You may look and feel rich because you're spending so much, but you're not financially free. You're financially independent of that situation because you got enough coming in to cover your expenses, but you're not financially free. And really, how you manage your expenses and all that, and the economy or like sudden changes in the economy, it's kind of a risky situation because you could be in a really bad situation if that income were to fall and you have such high expenses. So just know that it's not necessarily a certain income level. It's really how much you have coming in relative to the expenses that you have. And you can be financially free with a fairly small amount or much smaller than you probably think in passive income. Now, there's a lot of ways to build wealth and passive income in real estate. Like there's a lot of ways to make money. I'm going to share with you 3 different strategies that I believe anyone can do. Like if you've never done a deal before, I believe you can do one of these strategies. And there's, I've organized it in good, better, best. So just starting out, it's probably going to kind of flow in that path. But depending on your situation, best may be the perfect spot for you to start, or it actually may be the worst part for you to start. It may not be something that you can actually do right now. And I'm going to walk through each one of these and kind of break them out for you. So starting with good, this is the BRRRR strategy. You've probably heard of the BRRRR strategy before. It's very common. And pretty much every rental property that I've ever owned, I bought using the BRRRR strategy. It's very simple. Anyone can do it. And when you're following the fundamentals that you've learned in this masterclass, it's just a very simple strategy to not only just follow, but also execute. BRRRR is an acronym, and the B stands for buy. This is step 1. You're out there buying a property. These are typically off-market properties. They don't have to be off-market, but when you're buying deep discount properties, a lot of times, it's going to be off-market. And you're using investor financing, some sort of investor financing. Could be a hard money lender, which starting out, probably recommended for, we talked about this in the financing section. Could be a private money lender or some type of investment or non-QM type loan. But regardless, you're using investor financing to acquire the property. And if you buy it cheap enough, if you buy it at a good enough discount, you can get 100% financing. It's absolutely possible to get 100% financing. Not all lenders will do that, but there are a lot of them that will. And then as you get experience, there's a lot more private lenders that are comfortable with that as well. Again, if you get a good enough discount, you can get 100% financing. But it's very crucial in the buy phase. You have to finance it right to really execute the BRRRR strategy and do it in a way that's going to allow you to grow quickly. Because if you use conventional financing, that's great, but they're going to want 20% down, and you're pretty much going to be stuck with, that money's going to be stuck in the property for quite some time. Step 2, R. So rehab. This is when you're actually going in, you're getting a good discount on the property. It's probably because it needs a lot of work. That's just kind of what happens. It's either outdated or there's some repairs or whatever that needs to go into it to increase the value of the property to its current full market value, or ARV, after repair value. And just like what we were talking about in the rehabbing phase and estimating, evaluating deals, is you want to meet the comps. You're trying to meet the comps. You don't want to over rehab it, but you also don't want to under rehab it. You're looking at both the sale comps and the rent comps. Now, the reason why you're looking at the rent comps is because you are targeting a certain rental value. So homes that are renting for $2,000 a month, just an example, you need to make sure that when you're rehabbing the property, it looks like the other homes that are renting for about $2,000 a month. But you also, even though you're renting the property, you still have to consider the sale comps. Now, the condition of a property for sale and a property for rent, there's definitely going to be some variance typically, and you want to make sure that you're aware of both. And this comes into play in the refinance section, which I'm going to talk about that in a minute. But ultimately, you have to pay attention to both and find that sweet spot of where you can rehab it to a level where it's going to get a certain value, where you're hitting a certain ARV value, but also able to hit your rental value. Now, step 3 is rent. So you got it rehabbed. Now you go rent it out. You go find a good quality tenant. You do a background check. Always do a background. Now, if you're using a third-party manager, like property manager, they should be doing this part for you. But you want to do a background check. We talked about this in the income generation session. Trust but verify. But definitely do a background check and make sure it's thorough, because it's a lot easier to it's a lot better for you and easier to go through the hard work in the front end to make sure you have a high quality tenant that can afford the property than try to get a bad tenant out. Step 4, refinance. This is when you're going to refinance into a long-term loan. So remember, when you bought the property, you used short-term financing, hard money loan. So those are typically 12 months or so. And the interest rate's a lot higher. So it's meant to be short-term. It's meant to help you acquire the property quickly, finance it 100% if you buy it cheap enough, or at least much, a lot lower down than what you would have if you use like a conventional type of loan. But you need to refinance out of that. Now, the reason why I was saying in the rehab phase is you want to look at the ARV, you want to look at the sale comps too. So you're trying to find that sweet spot, is because when you're refinancing, there's going to be an appraisal, and they're going to base the value of the loan off of that appraisal. So when you're buying the property, they're basing the value of the loan based on the full ARV, like what is the full value, and then also what repairs does it take to get that value. It's loan to value. With here, they're going to be looking at the full value. So if you under rehab it and the appraisal comes back lower, even though you're just renting it out, then it means your actual loan amount that you're able to refi out into is going to be lower as well. So you may end up having to bring some money to the table. It really depends on how much you financed it for in the acquisition. So that's why I say you want to target both sale and rental comps. But you also want to, there's a whole bunch of different type of long-term loans for investors and landlords, you have to consider your exit strategy. Like, is this something you're going to own for 10 years, 15 years? Or are you going to like ride or die with this thing? Like you're riding this thing out until the tenant pays off the property, 15, 30 years. Or is it going to be a short-term play for you, 3 years, 5 years, then you're going to capture the equity, sell it, and reinvest. Like, you really have to consider that. So whether it's fixed or a floating rate loan, that's going to be part of that question. If it's a short-term duration, then maybe a floating rate loan might make sense. I say might, doesn't mean it does. So a lot of times when you're getting adjustable rate loans, they may be locked in for a certain amount of time period, 3 years, 5 years, 7 years, whatever. And the initial rate is going to be a little bit lower than, say, a 30-year fixed. But after that time period has elapsed, then your rate can be adjusted typically on an annual basis. And there's usually some sort of caps within that. You just need to know what those parameters are and factor that into your exit strategy. Because a lot of times, especially with investor type long-term financing, there's usually some sort of prepayment penalty. If you're going conventional, then you're probably not going to have a prepayment penalty, or you're not going to, at least not that I'm aware of. But if you have some type of long-term investor financing or local community bank, there might be a prepayment penalty. And usually it's a stair step. Like, say if it's a 3-year prepayment penalty, it means like year 1, you pay 3 points as a penalty. Year 2, you pay 2. And then year 3, you'll pay 1. So I had one that was a 5-year prepayment penalty, which is fine. I planned on owning it for a long time. I actually sold it, and I didn't pay any penalty because we rode that out. And so it's just important to know that if you know you're going to be having a property for 3 years or for 5 years, or let's just say 10, you're going to own it for 10 years because you love the location. You know this, that particular location is going to just explode in value, and you get good rent and great tenants and all this stuff. If you know you're going to own it for 10 years, then it may not really matter what the prepayment penalty is. The floating rate loan might matter, but the prepayment penalty itself may not matter. But if you know, hey, you're going to rent this thing out for maybe 2 years, 3 years, then getting a loan that has a 5-year prepayment penalty might not be the best choice. It doesn't mean it's not. It still could be. I've paid prepayment penalties. It's just at the time that loan made sense, and you just kind of wrap up those penalties to make sure it factored in. You're still getting the yield, the ROI that you're looking for on the property. So I just want to point those out because those are things that you have to consider when you're getting your long-term loan. But if you're doing conventional, then fixed rate, and you're not going to be dealing with prepayment penalties. And then last, repeat. That's the BRRRR strategy. It's buy, rehab, rent, refinance, and repeat. Rinse and repeat. Keep doing it over and over and over. And that's what we're going to do here. I'm going to just play out a plan of action and just kind of pretend like you're in this situation. Plan of action where you buy one property a year, just one property a year for 10 years. Just one. We're not buying 5 properties a year and going out and building this huge, massive portfolio. Just one property a year for 10 years. Anyone can do that regardless of your situation. Like, you can buy a property a year for 10 years. When you understand these fundamentals and put them in action, you can actually do that. Now, I know everyone you're all living in a different market, and we're going to use a certain avatar. So I've got a hypothetical property. We're going to buy this property, and to keep it simple, I'm keeping it static. So these numbers aren't going to change. I know every year there's inflation and whatnot. I get that. To keep it simple, we're going to have this static property. I also know that depending on what market you're in, a $250,000 house for a rental property is just like, it's insane because you would never get that in San Francisco. You can barely get like 2 sticks and laying them up against each other. That alone would be over 250,000. Okay, I get that. There are certain markets where you probably don't need to be buying rental properties. Like, it's true. Like, but here's the thing: you're not a tree. Like, you're not just fixed on your location and whatever's around you. You can actually invest in markets that may make more sense, especially for rental properties. So if your market's too expensive or you don't like it, invest somewhere else. And with the resources we have today, that's a lot easier than it was whenever I got started. So anyway, just play along. We're going to look at this property that has an ARV of $250,000. Now, this actually works. I was looking through when I put these numbers together. I went through a whole bunch of wholesale properties that were in my email list, and there were a lot of properties in there that actually had an ARV of around $250,000 that I could acquire, and it had the rehab budget where basically we'd be all in for roughly 70%, maybe a little bit more. It kind of depends on the property. But we have the loan here at 70%, which means you're all in at $175,000. Now, if you buy this property cheap enough, then after repairs and all that, you should be all in at $175,000. Could be a little bit more, that'd be money out of your pocket. But if it's a little bit less, then basically that means you're probably gonna have more cash flow, but also no money out. It'd be a no money down deal for you, which is great. Rent, $2,250. So for the longest time, the 1% rule with rental properties, that was something we'd follow, you'd look for, which means, hey, whatever the value of the property is, you could probably rent it out for 1% of that. So a $250,000 property, you rent out for $2,500. Well, then, housing prices just like went crazy over the last few years. So the 1% rule, it applies in some areas, but there's a lot of areas it just doesn't. So that means for you, either you need to go invest in those markets where it does apply, or you get closer to the 1% rule, because definitely closer you get there, then your overall yield, your cash flow is going to be much higher. Or you're just going to have to figure out what percentage you can get in your market and go with those numbers. And of course, run the numbers, they need to cash flow. Here, discounting a little bit, we're going with, basically the 0.9% rule, if you will. PITI, 1853. So principal, interest, taxes, and insurance. So your mortgage payment, essentially, all in. I had this at 8%. So obviously, if interest rates come down, they're much higher now than they were over the past few years. If they come down, then that's going to affect your cash flow. If they go up, then you're going to have to, adjust the rates. The higher interest rates are, that does impact cash flow. But ultimately, really, that ends up becoming like, if you just buy it cheap enough, you can still make the numbers work. Reserves, $225. This is 10%. Now, I keep it at 10%. When you're doing a full remodel on a property, your initial, at least front end, the first couple of years, repairs, capital expenditures, depending on the level of rehab you did, probably a little bit lower. But over time, you eventually have those repairs. You're definitely going to have them at some point. You're definitely going to have vacancy at some point. So it's just good practice to go ahead and write that in the very beginning, let it accrue. When those expenses occur, you have an account that has sufficient funds to be able to pay for those items. Because the last thing you want to do is have sudden expenditures, and you just don't have the cash and you have to come out of pocket. And then last, we got net cash flow, $172. Not a lot, right? Now, full disclosure here. This does not include property management. I've self-managed every property except for multifamily properties. So this does not include property management. If you want to include property management, then you need to factor that in as well. If you want to make sure it still cash flows very well, including property management, then you need to either put more money down so you have a lower monthly payment, or buy it cheaper, or both. Obviously, I like the idea of just buying it cheaper. I just want to be very clear about that. This doesn't include property management. All right. So again, what we're going to do is we're going to buy this property, this hypothetical property. We're going to buy one of these every single year for 10 years. And I just kind of want to show you and illustrate like what that looks when you compound it over time using the BRRRR strategy. So in year one, congrats, you got your first rental, $172 a month in cash flow, $75,000 in equity. Like that's pretty cool. But you're not rich yet. You can't quit your job. Like you can't post flashy like corporate jet, private jet photos on Instagram. Like just keep going. Year two, like cash flow doubles, equity doubles, great. Year three, a little bit more, a little over $500 a month in cash flow, $225,000 in equity. Not bad. Still not rich, but keep going. Year four. So year four, we have $689 in monthly cash flow, but something happened here that most people overlook. So most people are really fixated on the equity. You have $300,000 in equity in this situation, which is great. I mean, it's definitely a lot of equity. But there's something that really important happened here. You have $1 million in assets under management, or AUM. In other words, you own and control $1 million in real estate. And what that means is you're already a real estate millionaire. All you have to do at this point, all you have to do is just let your tenants pay off your mortgage. Once the tenants pay off your mortgage, if property values do not go up at all, if they stayed the exact same, when your tenants pay off your mortgage, you own $1 million in real estate free and clear. And then your cash flow is going to bump up too. Like you're already a real estate millionaire. And it only took 4 years. You don't need 100 houses. You don't need 500 houses. You don't need big multifamily apartment complexes to get this. Now, if you bought 2 houses a year, you can get there in 2 years. But as you can see, like from a cash flow standpoint, it's not a lot. I just want to really point out that it doesn't take a lot to build $1 million rental portfolio when you're just very consistent. But this is year 4. Remember, I said we're gonna play this out for 10 years and see what happens. So if you keep doing this year 4, keep doing it year 5, 6, 7, 8, 9, and 10. At the end of the 10 years, you'll have 10 properties, $1,700 in monthly cash flow, $750,000 in equity, like almost $1 million in equity now. That's like, it's not liquid, but it's much easier to access. But you have $2.25 million in assets under management. All you got to do is let your tenants pay them off, and you have $2.25 million in assets under management. And that's if property values don't go up at all. But we know property values do. Every 10 to 15 years, typically property values double. So by the time they ended up paying them off, you have significantly more than $2.25 million. Now, this really impacts pretty much everyone's retirement plan. Like whatever you have, like you may not be buying corporate jets and driving around in Lambos with this, but you've got a pretty good retirement nest egg here. It's pretty good. But there is a better way. That's using the BRRRR strategy. It's very static, just very consistent. You can do it over the long term. And I mean, we just drew out 10 years. Obviously, you buy 2 properties a year, and double it. You could continue to do it for 30, 40 years. Like it's a very static way. It's a very effective way to build wealth and some passive income over time. But there is a better way, and I'll call it the slow flip strategy. It basically requires the same effort, but it provides exponential returns. It has exponential returns for really 2 reasons. One, return on equity. Over time, the return you get on the equity in the property, because remember, you can't eat equity. Like it's there, it's nice, it looks great on your financial statement, and banks love it, but you can't eat that. You would actually have to sell it. So your overall return on that equity, so the cash flow that the property is producing based on the equity that you have in the property, decreases over time. So the slow flip strategy capitalizes on that. And it also capitalizes on the velocity of money. That's how quickly you're churning money, taking your earnings, reinvesting it back out into the market for exponential returns, where your money is starting to make money for you. So that's how this is able to ultimately get exponential returns. So what we're going to do is we're going to use that same hypothetical, that same property over 10 years, buying 1 property a year. But we're going to do it using the slow flip strategy. And the slow flip strategy uses one little nuance, and that is sell, which really you may think like, hey, if I'm building like a rental portfolio, why would I want to sell? Like that's kind of counterintuitive. And it's because we want to, keep our money flowing, not necessarily just letting our equity sit there and overall yields going down. So here's how this works. You buy a house 1 a year for 10 years. That's the same plan that we were doing in the BRRRR strategy, except for, which means over a 10-year period, you have 10 properties, right? But we're going to do something in year 6 that's different. Starting in year 6, so we're halfway in, we're going to look at your portfolio, and you're just going to pick one. Pick one of the properties, and you're going to sell it. Now, the property you choose might be the one that's the biggest headache. Like maybe the tenants in that area are headaches. Maybe the property itself is a headache, it's a little bit older, so it's always kind of like a maintenance hog. Or it just takes longer to rent in that area. Or maybe it just went up so much in value that it's not cash flowing as much anymore because taxes and insurance, they're kind of eating up your expenses. So you just, it's gone up in value, a lot of equity, but cash flow is very low. Whatever reason, you take one of the properties and you sell it. And when you sell the property, remember, you bought it at a discount. So you had built-in equity, but it's probably also gone up in value too. So you have more money in this property than when you started with. If you do this right, you should. Like, otherwise, you're not doing it right. You should have more money than when you started with, which means when you sell the property, now you're going to take that money and you're going to go back out and buy another, not just one, because that would just replace it. You're going to buy 2 more because you have more money than you started with. You're going to reinvest the proceeds and buy 2 more. So you're going to sell 1 to buy 2. So you're going to do that in year 6. In year 7, year 8, 9, and 10. So each one of those years, 6, 7, 8, 9, 10, you'll sell 1, buy 2 more, in addition to the one you already bought. And so what ends up happening is you have your first 10, you've sold five, you're 6, 7, 8, 9, 10, you sold five, but every one of those years you end up buying two more, and gives you a net amount of 15 properties at the end of 10 years. Now your cash flow has jumped up to $2,500, almost $2,600 a month. Like, it's still like you're not going to quit your job off $2,600 a month, but that's pretty good. That's pretty impactful for a lot of people. An extra $2,500 a month, like that does some things. Gives you a little extra option. But you have $1.13 million in equity. That's real. I mean, you can't eat equity, but that is real on your balance sheet. That looks great. Banks are going to love it. And hey, if you just decide to liquidate at this point, it'd be a lot of money that you'd have to play around with and invest in other things. But the biggest number here is the $3.75 million in assets under management. Once your tenants pay off the mortgage, you have $3.75 million, assuming the properties don't go up in value at all. And again, we know properties do. Every 10 to 15 years, properties tend to double. But this is just one a year. Like, what if you bought two a year? Well, if you bought two a year, then at the end of 20 years, or at the end of 10 years, you'd have 20 properties. Your first 20, like, you're about two a year, but year 6, 7, 8, 9, and 10, instead of selling one, now you're going to sell two. And then because you have more money, you're going to go out and buy four more, doubling them, giving you a net amount of 30 properties at the end of the 10 years. Now you have $5,100 in monthly cash flow, $2.25 million in equity, $7.5 million in assets under management. I don't care who you are, like, very, very few people would this not drastically change their lives. This is impactful. Now, if you just really want to hit it out of the park and go crazy with it, buy three a year. So you have 30 that's buying three a year, but you're 6, 7, 8, 9, 10. You're going to sell three to buy six more. So you're not just replacing them, you're doubling them. Gives you a net amount of 45 properties at the end of the 10 years. Now you have $7,700 a month in cash flow. At this point, I mean, there's a lot of people that could quit their job with $7,700 a month of cash flow. Like, that's pretty nice. You have over $3.3 million in equity and $11 million in assets under management. And again, even if properties don't go up in value, that's $11.25 million in equity. But properties tend to go up in value every 10 to 15 years. They'll double. It's a lot of equity, a lot of assets that you have under management. Like, this is life-changing. This would change pretty much anyone out there watching this. Probably would be life-changing for you. Now, little case study here. So this house, 2730 Mesquite, I talked about a little bit in one of the prior sessions. It's a house that was very near and dear to, like, my wife and I. It was it's the one appointment, like, she actually won the acquisition appointment, and I got this house from a pre-foreclosure. So I was knocking on doors and was able to go in and buy this house. Now, the pictures you see here are, before we rehabbed it. This house smelled. It smelled horrible. At the bottom, the bottom picture, kind of in the back, you can't see it, but it's blue carpet. I don't know when blue was in fashion, but in any case, they haven't cleaned this carpet in a long time. And they had dogs that lived in the house, huge stain marks. It smelled disgusting. Now, when I'm walking into a house like that, it smells like opportunity. So sat with them, negotiated a good deal, and we bought this house. It needed a lot of work, but it made sense for us. So we financed it. We bought it. We financed it with a hard money lender. So they loaned us 100% financing on it. We did the rehab. This was one of our first rehabs that we did. So, I mean, today we do a much better job, but really, still, we really did the same thing we would do now. Is we met the comps to the neighborhood, and for a rental property, getting the value that we needed, we were able to go in, and we didn't even need to do granite in this particular property. Rehabbed it, rented it out, refinanced into a long-term loan. And we ended up doing that, and it was about 3 years that the tenant, maybe a little bit longer, the tenant stayed in there. And at this point, the property values started going up a lot faster than rent. And that caused our taxes and insurance to go up as well. So our cash flow was decreasing. It was one of the examples I was saying, like, hey, why would you want to sell a property? Well, and this one, we had a ton of equity. That's good. But what comes with that is property taxes and insurance. They were growing at a faster rate than rent. So we ended up having to sell because our cash flow was it was falling. It was falling pretty quickly to zero. And we were able to capture that equity. So we did. We sold it. Now, when we sold it, we ended up doing another rehab. We looked at the comps again, figured out what value we wanted to target. And we did that. And we put it on the market, sold it. And this is what the breakdown of those numbers looked like. We bought this house for $85,000. It needed a lot of work. So between the original remodel, which most of the $65,000 here is from that original remodel, there were some extra things we did, on the make ready on the back end. But $65,000 in repairs, we cash flowed a total of $14,000 over the 3 or so years we had at least, and we sold it for $237,000. Our gross profit on this was $100,000. But here's the important lesson. We bought this house to flip. Like, it was never intended to, when we originally bought the house, we were remodeling this thing because we were going to flip it, but we didn't. I don't really remember exactly why we didn't flip it. It was probably because we both had jobs. We didn't need the extra money, but had we flipped it, we would have made about $30,000, $25,000, $30,000 or so. And that would have been a successful flip had we done that, but we didn't. Held on to it, and we refinanced it and got it leased out, had positive cash flow. We were able to hold it over several years, and instead of making 30 grand on it, we made over $100,000, which not only was it just making over $100,000, it's a lower tax rate. We were able to take depreciation during that time period, giving us, effectively like tax-free money because of all the depreciation. And we were able to let time do its thing, let appreciation do its thing, and take that proceed. And ultimately, this is what allowed me to quit my job and reinvest it back into the business. I've got another version of this that break out several other examples of this same thing on how we've done this over and over again. And this is why I encourage you, like house flipping, wholesaling. Those are great ways to make money. But at the end of the day, it's owning assets. Like, wealthy people own assets. So find a way to hold more. And if you can do something like this, using the BRRRR strategy or the slow flip strategy, specifically here is a slow flip strategy because you're selling it, reinvesting it back in, it can really exponentially grow your wealth and your lifestyle and your passive income over really a few short years. Now, in reality, you're probably not going to be building a 30, 40, 50 plus unit or at least single family unit portfolio. Probably not going to build some portfolio where you've got 50 houses. You can, and I know people who've done that, who've done like well over 100. But at some point, you're probably going to end up just trading up to bigger deals like multifamily because you have scales of economy. Or you're going to invest in other people's deals. And investing in other people's deals, this is, depending on your situation, this may be the best strategy for you to start with. Like if you're busy, if you got a full-time job and it's really busy, and you don't want to get involved in the daily operations of a real estate investment company, doing marketing and talking with wholesalers and agents and negotiations and repairs and all this stuff, like investing in other people's deals might be the best option for you. Essentially, what you're doing here is you're leveraging someone else's experience, their team, their resources, ultimately to earn a great return on your money. That's what you're doing. That's what my company does, invested equity. That's what we do for our investors. Now, the biggest thing here, because when you're doing this, you really get a lot of the same benefits. Now it depends. Like if it's just a debt, like you're actually just being a private money lender, then probably not have equity participation. So therefore you may not get depreciation, stuff like that. But a lot of times, especially in what we do, investors get the same benefits that I enjoy as a full-time operator. They get a lot of the same benefits, and ultimately they're doing it with a much less time cost because you're leveraging someone else. And that allows you to grow a lot faster because you don't have that time cost in operations. So the most important thing here is, if you are considering or ever consider investing in other people's deals, is you have to fully underwrite the operator, because they're the ones you're really investing in. So you want to find a good, honest, trustworthy operator that has experience. They're investing in something that you know and understand. You don't have to be a pro like them, but you do need to know and have a basic understanding of what that asset is, whether it's single family, like short-term rentals, mobile home parks, multifamily, self-storage, whatever that is. Like, you need to have a pretty decent understanding of what that is. And you have to really trust the operator, do your underwriting on the operator. And then when you have that good synergy, you can invest with them on much bigger deals than you would ever be able to do yourself. And again, just faster and with significantly less time cost. And again, depending on your situation, this may be what you would want to start with. But if you're starting out with maybe less resources, especially less cash, then going out with the burst strategy or the slow flip strategy and working up to this is probably going to be the next best option. Now, either way, you have to know your numbers. So you have to know your numbers, which with rental properties, it's fairly easy to do. Like, most things are kind of known up front. You can pull comps on value, you can pull comps on rent value and sale value. You can get estimations, which you should be doing all this. Get estimates from contractors on the rehab bid and all this stuff. So knowing your numbers, that's, at least in my opinion, kind of the simple part. The part where a lot of people get tripped up is management. I recommend third-party management, like working with a third-party property manager, especially if you have a full-time job or you just don't want to deal with issues that come up. Work with a third-party property manager. If you're going to do it yourself, which I have, every property other than multifamily, I've self-managed or in my team, but I'm full-time, my team's full-time. We've got certain systems in place to handle things that come up. So you just want to make sure that you build those out, and all at the same time, like, make sure you're abiding by local, state, and federal landlord-tenant laws. Financing, staying on top of your financing. Always be networking with new financing partners, both long-term and short-term. Staying on top of your accounting. This is your books, which means you should not be doing your own bookkeeping. Like, unless you're like a certified bookkeeper, and even still, you probably shouldn't be doing it. Let someone else do that. It's a $30, $50 an hour or so job. Let someone else do that. They're going to do it probably a lot better than you could. And then that way, whenever you give it over to your CPA at the end of the year, it'll be easier for them to file your tax returns or complete your tax return, which also goes to don't go with TurboTax. Like, you need to be hiring professionals to do this work. They're gonna bring so much more in value than you'll ever pay them. Promise you. Don't use TurboTax when you're filing your tax returns. When you're doing real estate, find a CPA and an accountant, a bookkeeper that knows real estate. You can get referrals, and I just promise you, it's going to be far worth whatever you end up paying them. And then last, escrow. You have to escrow for vacancy, repairs, and capital expenditures. Those costs always come up. It's just a matter of time. And even though you may be able to personally take a big expense that comes up on one property, well, what if 3 or 4 come up kind of like all within a couple months? Like, do you want to take that hit personally? It's a lot easier if you have an account set up that already has the cash in that because you've escrowed. So don't put yourself in that kind of situation where basically you're elevating your risk by not having that already escrowed. And last, you have to reinvest. It's really hard to grow wealth and passive income and all that if you're just spending everything you're making. Remember that way back in the beginning, I was talking about financial independence. If you have 30 grand a month of passive income, but you're spending 30 grand a month, like, you're not financially free. You may be independent, but kind of a risky situation. Reinvest. At some point, especially after always reinvest, in my opinion, as much as you possibly can for as long as you can. But if you do that continuously for 5 or 10 years, like, it doesn't take long to start to snowball. And just know that when you do this, when you follow these fundamentals, and especially the last part, building wealth, it really starts to compound, and you can really create results. Not just results like one-time results, but lasting results. And that's really what matters, because your success matters. It affects your life, it affects your family, it affects your community, anything and everything around you and what you care about. Your success matters. And don't take that for granted. Like, that should weigh on you to really, every single day, every single morning when you get out of bed, every day when you go to work, when you're working on your goals, everything you do, know that your success and what you do matters. It affects everyone around you. I like this quote from Theodore Roosevelt. I'm just going to read it here. It is not the critic who counts, not the man who points out how the strong man stumbles, or where the doer of deeds could have done them better. The credit belongs to the man who is actually in the arena, whose face is marred by dust and sweat and blood, who strives valiantly, who errs, who comes short again and again. Because there is no effort without error and shortcoming. But who does actually strive to do the deeds? Who knows great enthusiasms, the great devotions? Who spends himself in a worthy cause? Who, at the best, knows in the end the triumph of high achievement? And who, at the worst, if he fails, at least fails while daring greatly, so that his place shall never be with those cold and timid souls who neither know victory nor defeat. I just love that quote. I truly hope you got a ton of value out of this masterclass, and that you start implementing these fundamentals and do it in a way where you build something great, something that changes your life. And if you did get value out of this masterclass, I only have one ask, just one. Share it with someone that you know that would greatly benefit from it. It just might change their life. Thanks again for watching.